Let's take a look at a brief discussion on parity trades, covered calls versus cash secured puts, and why it seems investors prefer one over the other. Last week, the same question came up during a coaching session and during just a direct call from a potential covered call customer. Looking at covered calls versus naked puts or cash secured puts when comparing the same strike price and the same expiration date. Both investors had the same questions. Why does it seem that so many people suggest or trade covered calls more than cash secured puts? When we look at the profit and loss chart, these are parity trades. They have the same exact risk-reward profile when you're comparing the same strike and same expiration. Is there really a benefit of one over the other? A simple covered call trade. The actions, we buy shares of stock in groups of a 100 block. We then sell a call against the owned shares. The call is a contract. It obligates us to deliver shares of our underlying stock that we purchased if the stock is trading above the call strike price. Here we're going to take a look at an in-the-money covered call position. Buy 100 shares of Micron MU at 58.47. Sell the 09th of December expiration, about 60 days away, 55 strike call, $3.47 below the current stock price. We collect a premium of $4.20. Now the total out of pocket would be $54.27 per share. The max return if the stock is above 55 and we're assigned the shares of stock forcing to deliver our shares of stock would be 73 cents per share or 1.3% of our total investment amount. The break even essentially is the cost basis, $54.27, but this gives us roughly a 7.2% downside protection. In other words, how far can the stock fall before we're technically losing money on the position when it's currently at 58.47. Over here on the right, we see the profit and loss chart for a simple 100 shares of MU at 58.47, selling one in the money, 9th of December, 55 call for $4.20. Brings our cost basis and break even down to 54.27. Anything above that is a profit, and as long as MU stays above 55, we deliver our shares of stock for $55 per share. We keep the $4.20 premium. We make a profit of 73 cents per share, $73, for the cost basis of $5,427 out of pocket, and we have a 1.3% maximum return, the return if assigned on the covered call position. If the stock falls below 54.27, our break even, we start to lose money on the position, and we have a lot of downside if the stock does fall a significant amount. The parity, cash secured put trade or naked put. Our actions, we sell a put option. We do not buy the shares of stock. However, we're going to put up the capital due to the obligation of the put. Here we'd sell the same strike and same expiration, the 09 December 55 put. And at the same time we entered our covered call, the midpoint premium for the 09 December 55 put was 68 cents. I entered this contract. It obligates me to buy shares of stock if the stock is trading below $55 per share. So my broker, to be totally cash secured, I'd have to put up the $55 per share or $5,500 if I sold one contract of the 09 December 55 put. The max profit, if the stock remains above 55, same as the covered call, but in this case the put expires worthless. We have no obligation. We keep these 68 cents, so we have roughly a 1.3% yield. If the stock is trading slightly below 55, we will be forced to buy shares of stock at the put strike price. We'd purchase shares of stock of $55. We keep the 68 cents regardless, so we'd own shares of stock with effectively a cost basis of $54.32. This is our break even for the cash secured put. It gives us a 7.1% to break even, meaning the stock can fall 7.1% before we start losing money on the cash secured put. We see here on the risk reward chart over on the right, the stock base stays above 55. The put expires worthless. We make the maximum profit or yield of 1.3%. The stock falls to 54.32. We're forced to buy shares of stock at 55. We keep the 68 cents, so we have a cost basis of 54.32. We're effectively at break even. We can convert it to a covered call, sell the shares of stock, and have a wash on the position. As with the covered call, anything below 54.32, we enter in a loss on the transition. And if it continues to fall further in price by a significant amount, we may have a significant loss, unrealized or realized, on the trade. Let's table that very quickly. In the money covered call, Micron stays at the same price, 58.47. We're assigned on the in-the-money covered call. We make the max return of 1.3%. Same with the out-of-the-money naked put. But in this case, the stock remains around 58 or 58.50. Our 55 put expires worthless. We keep the 68 cents, and that's a 1.3% yield. The put expires worthless. Micron falls 5%, down about $2.92 to 55.55. MU is still above the strike price of our call. We're assigned on the shares. We make the 1.3%. The stock is still above the 55 strike of our out-of-the-money naked put. The put still expires, even with a 5% decline. We make the 1.3% yield off of the cash obligation we put up for the transaction. The put expires worthless. Micron falls 10%, drops down about $5.50 to about 52.60. Now remember, we had a lower cost basis on the covered call position because we collected the premium of $4.20. With the stock at 52.62, down 10% from when we entered the trade, we'd have a loss of $1.65 from our cost basis, or 3%. That downside protection helped hedge the loss. On our cash secured naked put, stock's at 52.62. We'd either be assigned shares of stock at 55, having a cost basis of 54.32, but this would still be a loss of 170 or 3.1%. Just the 5-cent difference between the 73 cents we collected on the covered call and only the 68 cents that we saw on the cash secured naked put. MU has a bigger drop, falls 25%. We're down $14.62 to a cost of the share of $43.85. On our covered call cost basis, this would be a loss of $10.42 or 19.2%. For the out-of-the-money naked put, this would be an unrealized loss, but a loss of $10.47. We'd be forced to buy shares of stock at 55. We kept the 68 cents. We have a cost base of the shares of 54.32 that are trading at 43.85. An unrealized loss of 19.3%. The downside protection of the percent to break even helps hedge the loss a little bit, but now we're negating many trades of that 1 to 2% return if assigned or yield as we let it get too far away. And just for an example, wouldn't expect this to happen, but we've seen it happen before. If MU dropped 50%, lost $29.23 of its current value, stock's trading at around $29.24, we'd have a loss of $25.03 on the covered call or 46.1% on our cost basis. For the out-of-the-money cash secured put, we'd have a loss of $25.08 or 46.2% from our cost basis. So the risk rewards are the same. The downside risk is the same when comparing the same strikes of a covered call position and an out-of-the-money naked put, of course, comparing the same expiration dates as well. But the two investors, when they were just getting started out, they were looking for information on covered call trades, cash secured naked puts, naked put trades. There was more data and more suggestions and more education on covered calls than naked puts. Why so many more covered calls than naked put discussions? Well, one thing is a brokerage bias. If you apply to trade options at a big broker, Fidelity, for example, E-Trade, things of that nature, you might just get level 1 trading, which just allows you to do covered call positions, buy shares of stock, and sell calls. Now, don't get us started on that. Aside from why aren't cash secured naked puts if they're parity trades not allowed on level 1, Ernie and I always ask, why aren't married put positions or collars where you could buy a put against the stock to protect the downside guaranteed better than a stop loss? Why aren't these allowed in level 1? If they're not, the downside's still open with the covered call trade. Most people just getting started out into options are stock investors that are looking for a little bit more oomph or a little bit more premium on their positions. They own stock. They've been trading stock positions, trading in a 401k, investing for years and years. Now they see the idea of renting out their stock on a consistent basis, whether it's a core holding in their account or another position, or they want to get a dividend-like income on a week-by-week or monthly basis by selling out-of-the-money calls against the stock holdings in their portfolio. Why might others prefer covered calls over cash-secured naked puts? Maybe it does come down to the confidence of ownership. In a covered call, I own the stock. I have to buy shares of stock. But it's just like owning a house and renting it out, or having a car, having art. You own a tangible asset. Whereas the cash secured naked put, you're selling a contract that obligates you to maybe buy shares of an asset. You put up money to enter the trade, collateral, but you don't actually own anything. Maybe it's a little bit of psychology why more investors prefer covered calls over naked puts, because there's a tangible asset that they own in their account that they can see, and they can sell something against as a covered call to generate premium, rather than selling a put, which is a contract and an obligation, and you put up collateral, but you technically do not own anything yet, and you might not end up owning anything at all if it works out as you want. Maybe that's part of the issue. Another issue might be that, well, understanding puts is difficult. Once you start trading options, you start researching options, buying calls, covered call positions, things of that nature. Then you have to think about puts. We have to start thinking about puts in reverse. Understanding puts might be a little bit difficult for new investors to get in. We have to think, hey, as the stock's falling, the put's gaining in price, but my call would be losing in price. The put has a negative delta. As the stock moves up 1 point, well, the put would decline. But if the stock falls 1 or 2 points, the put's going to gain in value with a negative delta and other concepts. Maybe that's a reason why you see more information on covered calls over naked puts as well. But regardless of which strategy, again, when you're comparing the same strike price and the same expiration date, they are parity trades of one another. More importantly, PowerOptions offers you the tools to find the positions that match your risk-reward tolerance in either strategy. Patented search tools, defaults in those search tools for the covered calls or the naked puts that you can use as a stepping stone to create your own personal trade. The monthly and weekly picks of the day for covered calls and naked puts that Ernie developed, plus tools to look for naked puts and covered calls that match your risk-reward tolerance one security at a time. And in addition to that, maybe more importantly, the tools to track and manage the positions. You can track trades in the portfolio tools. There's various views in the portfolio when you're tracking your positions for liquidation and future expiration, Greeks, important dates, allocation, and more. You can set alerts on your individual positions based on the stock price, stock change, change in position, range in or out of the money, probability of the options, and more. And with one click, evaluate rollout opportunities and adjustments for the covered call, naked put, or cash secured put, and many other strategies that are supported on PowerOptions. Remember, you can start your trial at any time. Just go to PowerOp.com. No credit card is required. And further education for either approach, hey, head on over to our YouTube channel. Look for PowerOptions, at PowerOptions on YouTube. There are playlists for selling naked or cash secured puts, covered calls, where we focus on the strategy, structure, criteria for the underlying security and the options themselves, expectations, management ideas, rollout opportunities, and much, much more.